Chapter 16, Auditing Operations and Completing the Audit. Today, with great emphasis being placed upon corporate earnings as an indicator of the health and well-being of corporations, as well as the overall economy, the income statement is of fundamental importance to management, stockholders, creditors, employees, and the government. In fact, accountants generally agree that the measurement of income is the most important single function of accounting. The doctrine of conservatism is a powerful force influencing decisions on revenues and expenses. The concept remains important in large part due to the subjectivity involved with many accounting estimates. As for expected future credit losses on receivables, lives of assets, and the warranty liability for products sold. Conservatism in the valuation of assets means that when two or more reasonable alternative values are indicated, the accountant will choose the lower amount. For valuation of liabilities, the higher amount is chosen. Therefore, when applied to the income statement, the conservatism concept results in a low or conservative income figure. Nevertheless, auditors must recognize that overemphasis on conservatism in financial reporting is a narrow and short-sighted approach to meeting the needs of our society. To be of greatest value, financial statements should be neutral rather than understate financial position and operating results. Thus, the FASB has rejected conservatism as a desirable characteristic of accounting information, suggesting that it is inconsistent with neutrality. The objectives for the audit of operations are, as the other audit plans, to use the understanding of the client and its environment to consider inherent risk, including fraud risk related to revenues and expenses, consider internal control over revenues and expenses, and assess the risk of material misstatement of revenues and expenses, and design further audit procedures as are shown. The auditor's review of many revenues and expenses were considered when balance sheet accounts were audited. Revenues such as sales were considered in relationship to accounts receivable, interest income with notes receivable, and dividends with securities and other investments. Rents, gains, and losses were considered in the audit of property, plant, and equipment. Royalties were included in the audit with intangible assets. Expenses such as the allowance for accounts and notes uncollectible were included with audits of accounts and notes receivable. Losses were analyzed in relation to securities and investments. Purchases, cost of goods sold, and payroll were included with examination of inventories. Depreciation and repairs and maintenance were reviewed in the audit of property, plant, and equipment. Amortization with intangible assets, and interest expense with interest-bearing debt. Miscellaneous revenue by its very nature is a mixture of minor items, some non-recurring and others likely to be received at irregular intervals. Because of the nature of items often recorded in the miscellaneous revenue account, the auditors will obtain an analysis of the account. Among the items the auditors might find improperly included as miscellaneous revenue are the following: collections of previously written off accounts or notes receivable, which should properly be recorded as a reduction of the allowance for uncollectible notes and accounts. Write-offs of old outstanding checks or unclaimed wages that may need to be surrendered to the state are credited to a liability account. Proceeds from sales of scrap sales proceeds generally should be applied to reduce cost of goods sold. Rebates or refunds of insurance premiums which should offset related expenses or unexpired insurance may be found. Proceeds from sales of plant assets that should be recorded in the determination of gains or loss of the assets sold. Auditors should propose adjusting journal entries to classify correctly any material items of the type described in the previous slide. Before concluding the work on revenue, the auditor should perform analytical procedures and investigate unusual fluctuations. Material amounts of unrecorded revenue, as well as significant misclassifications affecting revenue accounts, may be discovered by these procedures. In the audit of selling, general, and administrative expenses, the auditor will perform analytical procedures. These procedures will be to develop an expectation of the account balance. The auditor will develop an expectation of the account balance by considering factors such as budgeted amounts, the prior year audited balances, industry averages, relationships among financial data, and relevant non-financial data. Next, the auditor will determine the audit of difference from the expectation that can be accepted without investigation. The auditors use their estimates of materiality to arrive at which differences are to be investigated and which might be expected to occur by chance. The auditor will make comparisons of the revenue and expense accounts with expected amounts to reveal significant differences that warrant investigation. The starting point for investigating significant variations in expenses generally is inquiry of management. Then the auditors substantiate management's explanations for significant variation by various means, including analyses of accounts. As a result of the previous procedures, the auditors will have chosen certain expense accounts for further verification. The client should be requested to provide further analyses of the accounts selected, together with related vouchers and other supporting documents for the auditor's review. The AICPA has suggested investigation of the following accounts: advertising, research and development, legal expenses and other professional fees, maintenance and repairs, and rents and royalties. Income tax returns generally require schedules for officers' salaries, directors' fees, taxes, travel and entertainment, contributions, and casualty losses. Accordingly, the auditor should obtain or prepare analyses of these expenses that were not analyzed when performing other audit steps. The auditor should bear in mind that details of these expenses will probably be closely scrutinized when the state or federal revenue agents examine the client's tax returns. This slide shows an analysis of the legal and other professional fees account. The auditor will be determining through the review that the account has only amounts properly classified as professional fees, such as legal and accounting services. Sometimes the analysis will show that there are fees that are properly chargeable to cost of issuing stock or debt instruments or to cost of business combinations in this account. The auditor can also find the names of attorneys to whom letters should be sent requesting information as to pending litigation and other loss contingencies. The payroll in many companies is the largest operating cost and therefore deserves the close attention of management as well as the auditors. In the past, payroll frauds were common and often substantial. Today, however, such frauds may be more difficult to conceal because of extensive segregation of duties relating to payroll, the use of computers with proper controls for preparation of payrolls, and the necessity of filing frequent reports to the government listing employees' earnings and tax withholdings. The most important of all controls over payroll is the division of payroll work among several departments of the company. Payroll activities should include the functions of employment, human resources, timekeeping, payroll preparation and record keeping, and distribution of pay to employees. For effective internal control, a separate department of the company should handle each of these functions. Typical questions that are asked by the auditors prior to the completion of an internal control questionnaire, a system flowchart, or other record of payroll controls are the following. Are employees paid by check or direct deposit? Is a payroll bank account maintained on an impressed basis? Are the activities of timekeeping, payroll compilation, payroll check signing, and paycheck distribution performed by separate departments or employees? Are all operations involved in the preparation of payroll subjected to independent verification before the paychecks are distributed? Are employee time reports approved by supervisors? And is the payroll bank account reconciled monthly by an employee having no other payroll duties? After obtaining an understanding of the client and its environment, including internal control, the auditor will assess the risk of material misstatement and design further audit procedures, including test of controls over payroll transactions for selected pay periods. The procedures include comparing the names and wage or salary rates to records maintained by the Human Resources Department, comparing time shown on payroll to time cards and time reports approved by supervisors. If payroll is based on piecework rates rather than hourly rates, reconcile earnings with production records. Determine the basis of deductions from payroll and compare with records of deductions authorized by employees. Test extension and footing of payroll. Next, the auditor will compare the total of payroll with the total of payroll checks issued and the total of payroll with total labor cost summary prepared by the cost accounting department. If wages are paid in cash, compare receipts obtained from employees with payroll records. If wages are paid by check, compare paid checks with payroll and compare endorsements to signatures on withholding tax exemption certificates. If wages are paid by direct deposit, compare listing of employee payments with payroll and direct deposit authorizations. Observe the use of time clocks by employees reporting for work and investigate time cards not used. This slide shows some of the many ways that data analytics can be used in the audit of payroll. This slide lists the major substantive procedures for payroll and the primary audit objectives for each. The auditor will perform analytical procedures to test the reasonableness of payroll expense, then investigate any extraordinary fluctuations in salaries, wages, and commissions. Next, the auditor will prepare a summary of compensation of officers for the year and compare to contracts, minutes of directors' meetings, or other authorization. The auditor will test the period end accrual of payroll expenses and the compensation earned under profit sharing or bonus plans. The auditor will also test commission earnings by examination of contracts and detailed supporting records. Last, the auditor will test pension obligations by reference to authorized pension plans and supporting records. The statement of cash flows is prepared from other financial statements and from analysis of increases and decreases in selected account balances. The amounts included in the statement of cash flows are audited in conjunction with the audit of balance sheet and income statement accounts. Thus, limited substantive procedures are necessary. Since receipts and payments must be classified in the statement of cash flows as to whether they are from operating, investing, or financing activities, the presentation and disclosure audit objective is especially important. The search for unrecorded liabilities includes procedures performed near the date of the auditor's report, such as examining subsequent cash disbursements. These procedures are designed to detect liabilities that existed at year-end but were omitted from the liabilities recorded in the client's financial statements. The auditor should review the minutes of meetings of stockholders and directors, including important subcommittees of directors, such as the Audit Committee and the Investment Committee. The auditor should perform analytical procedures near the end of the audit to aid in the assessment of the validity of the conclusions reached, including the opinion to be issued. Most loss contingencies encompass both contingent liabilities but also asset impairment. First, auditors should determine the existence of the loss contingencies. Second, the auditor should appraise the probability that a loss has been incurred and its amount. Auditors must also search for subsequent events that occur after the balance sheet date, but before the financial statements are issued. Last, the auditor will need to obtain the management representation letter. In FASB ASC 450-20 loss contingencies, the FASB set forth the criteria for accounting for loss contingencies. Such losses should be reflected in the accounting records when both of the following conditions are met. Information available prior to the issuance of the financial statements indicates that it is probable that a loss has been sustained before the balance sheet date, and the amount of the loss can be reasonably estimated. Loss contingencies that do not meet both of the above criteria should still be disclosed in a note to the financial statements when there is at least a reasonable possibility that a loss has been incurred. If the amount of the loss cannot be reasonably estimated, the disclosure should include either a range of loss or a statement that an estimate cannot be made. Certain contingent liabilities traditionally have been disclosed in financial statements, even though the possibility that a loss has occurred is remote. Such items include notes receivable discounted and guarantee endorsements. With the exception of those items for which disclosure is traditional, disclosure need not be made of loss contingencies when the possibility of loss is remote. Perhaps the most common loss contingency appearing in the financial statements is that stemming from actual or potential litigation. AICPA AUC 501 and PCAOB 337 provides guidance in this area and requires that auditors design and perform audit procedures to identify litigation, claims, and assessments, including inquiring about these matters with management and others in the organization, including in-house legal counsel, obtaining from management's description and evaluation of litigation, claims, and assessments, including identification of those matters referred to legal counsel, reviewing minutes of meetings of those charged with governance, documents in management's possession regarding litigation, claims, and assessments, and correspondence with legal counsel, and reviewing legal expense accounts and invoices from legal counsel. The auditor should obtain from management a list describing and evaluating any threatened or pending litigation. Other types of contingencies include income tax disputes with the IRS, accommodation endorsements and other guarantees of indebtedness, accounts receivable sold or assigned with recourse, which means that there is a guarantee of collectability given. Environmental remediation liability laws written at all levels of government are increasingly leading to both contingent and accrued liabilities. Closely related to contingent liabilities are obligations termed commitments. The auditor may discover during their audit any of the following commitments: inventory purchase commitments, commitments to sell merchandise at specified prices, contracts for the construction of plant and equipment, pension or profit sharing plans, long-term operating leases of plant and equipment, employee stock option plans, long-term operating leases of plant and equipment, employee stock option plans, and employment contracts with key officers. Since the commitments are contractual but will occur in the future, there is a possibility of a loss occurring. All classes of material commitments may be described in a single note to financial statements, or they may be included in a contingencies and commitments note. Last, there are general risk contingencies that represent a loss that might occur in the future, as opposed to a loss contingency that might have occurred in the past. Since the events that might produce a loss actually have not occurred and they are part of the general business environment, they need not be disclosed. The auditor's procedures to detect and evaluate loss contingencies include the following procedures: review the minutes of directors' meetings to the date of completion of field work, send a letter of inquiry to the client's lawyer requesting a description or evaluation of management's description of the nature, outcome, estimate of probable loss or range of loss for pending and threatened litigation and tax disputes, and an evaluation of management's description of any unasserted claims and a statement of the amount of any unbilled legal fees. The auditor should send confirmation letters to financial institutions to request information on contingent liabilities of the company. They should review correspondence with financial institutions for evidence of accommodation endorsements, guarantees of indebtedness, or sales or assignments of accounts receivable, and review reports and correspondence from regulatory agencies to identify potential assessments or fines. Last, they should obtain a management representation letter from the client indicating that all liabilities known to officers are recorded or disclosed. This chart summarizes the auditor's responsibilities for subsequent events with respect to the balance sheet date, the date of the audit report, and date the auditors grant the client permission to use the audit report, the report release date. Type 1 subsequent events are those representing conditions existing on or before the balance sheet date. This type of subsequent event requires that the financial statement account be adjusted to reflect the changes in estimates resulting from the additional evidence. Type 2 events are those that arose after the date of the financial statements. These events do not require adjustment to the dollar amount shown in the financial statements, but they should be disclosed in the financial statement notes if the statements otherwise would be misleading. Generally, the auditor's responsibility for performing procedures to gather evidence as to subsequent events extends only through the date of the audit report. However, the auditors are responsible for evaluating subsequent events that come to their attention prior to the report release date. For the period after year-end through the date of the auditor's report, the auditor should perform audit procedures to obtain sufficient, appropriate audit evidence that all subsequent events are identified. The procedures that should be followed are to inquire of management and those charged with governance about whether subsequent events have occurred. Read available minutes of directors, stockholders, and appropriate committee meetings that have been held after the date of the financial statements, and inquire about matters discussed at any such meeting for which minutes are not yet available. Read the company's latest interim financial statements, if any. The primary purpose of the representation letter is to have the client's principal officers acknowledge that they are primarily responsible for the fairness of the financial statements. Since the financial statements must reflect all material subsequent events, the representation letter should be dated as of the date of the audit report. While representation letters are part of the evidence the auditors obtain, they are not a substitute for the application of other necessary audit procedures. Misstatements identified by the auditors may include amounts that are known to be misstated, likely to be misstated, or both. Known misstatements are specific misstatements identified during the course of the audit. Likely misstatements may be due to either extrapolation from audit evidence or differences in accounting estimates. Extrapolation differences are generally projected misstatements determined through the use of sampling. Accounting estimate differences are differences between management's and the auditor's judgment concerning the appropriate amounts of accounting estimates. Known misstatements should be adjusted unless trivial, and likely misstatements should be used to identify accounts that management should review in order to identify and correct other misstatements. When accounting estimates include what the auditors believe to be likely misstatements, the auditor should request that management review the assumptions and methods used in developing their estimate. Any known material misstatement must be corrected, or the auditors cannot issue an unqualified opinion on the financial statements. The consideration of adjustments must be based on both quantitative and qualitative factors. This slide shows the consideration of over and understatements for an audit, including the known and the likely or projected misstatements. The auditor will conclude that the risk of material misstatement is sufficiently low to issue an unqualified opinion only when the aggregated misstatements, both known and likely, are significantly less than a material amount. The auditor should include the tax effects of the adjustments. Last, the auditor will show the materiality amounts for each of the items to support the conclusions made. Since both AICPA AUC 320 and PCAOB 312 and SEC Staff Accounting Bulletin number 99 consider materiality, they provide examples of qualitative factors that are likely to be material. These include the following factors that may be material when they arise from an item capable of precise measurement rather than from an estimate: mask a change in earnings or other trends, hide a failure to meet analyst consensus expectations for the company, change a loss into income or vice versa, concern a particularly important segment or other portion of the registrant's business, affect compliance with regulatory requirements, loan covenants, or other contractual requirements, increase management's compensation, involve concealment of an unlawful transaction, or of an amount that management or the auditors believe would affect the stock's price. Historically, auditors have been allowed to use either of two approaches to make a decision concerning previous year's uncorrected misstatements. The rollover approach considers only the amount of misstatement originating in the current year income statement. The Iron Curtain approach considers the balance sheet effect of correcting the total misstatement existing at the end of the year, regardless of when the misstatement originated. To illustrate these approaches, consider if we have a $70,000 current year misstatement and a $60,000 balance sheet carryover from the preceding year. If the auditor used the rollover approach, then the auditor would only consider the $70,000 current year misstatement. If the auditor used the Iron Curtain approach, then they would consider the entire $130,000. The SEC decreased the auditor's flexibility in choosing between the two methods in SEC SAB 108. The statement requires that if either approach results in material misstatement, an adjustment must be made. Thus, if the $130,000 misstatement is material to the financial statements, the $130,000 adjustment would be made either all to the current year statement if the $60,000 is immaterial to this year's statement, or $70,000 to this year's statement and $60,000 to the prior year if the $60,000 is material to this year's statement. AICPA AUC 300 and PCAOB 31 states that the work performed by each assistant should be reviewed to determine whether it was adequately performed and documented, and to evaluate the results relative to the conclusion to be presented in the auditor's report. The review of the work is primarily accomplished through a review of the audit working papers, primarily by the seniors on the engagement throughout the audit. The review of the working papers by the audit partners and managers will generally not be done until near or after completion of field work. The partner and manager will devote special attention to those accounts that have a higher risk of material misstatement, such as the significant accounting estimates of inventory obsolescence and warranty obligations. Finally, if a second partner review is required by the CPA firm's quality control policies, this review is usually performed just prior to issuance of the audit report. This slide summarizes the effect on the audit report of supplementary information. If the information is properly reported and the other information is in documents containing financial statements, then no change is required and no other matter paragraph need be added, although the auditor may choose to include one if disclaiming an opinion on the other information. If the information is required supplementary information, then another matter paragraph is added that no assurance is provided on the information. If the supplementary information is in relation to the financial statements as a whole, then the other matter paragraph is added that the information is fairly stated in all material respects in relation to the financial statements as a whole. If any of the three types of information is improperly presented, then the other matter paragraph indicates that information is incorrect or omitted, but the overall audit opinion remains unmodified unless there is a misstatement in the financial statements themselves that makes a qualified or adverse opinion appropriate. AICPA AUC 260 and PCAOB Standards number 16 require that an oral or written communication of certain information to those charged with governance of the company being audited. Those charged with governance means those with responsibility for overseeing the strategic direction of the entity and obligations related to the accountability of the entity. This ordinarily includes the board of directors or audit committee. The auditors state their responsibility under generally accepted auditing standards and management's responsibilities, and an overview of the plan, scope, and timing of the audit and significant findings. The discussion of significant findings from the audit is particularly complex in that it involves communication of qualitative aspects of the company's significant accounting policies, audit difficulties encountered, uncorrected misstatements, disagreements with management consultations with other accountants, auditor independence issues, and other significant issues. After issuance of the audit report, the CPA firm may encounter evidence indicating that the client's financial statements were materially misstated or lacked required disclosures. The auditors should immediately investigate such subsequently discovered facts. If the auditors determine that the facts are significant and existed at the date of the audit report, they should advise the client to make appropriate disclosure of the facts to anyone actually or likely to be relying upon the audit report and the related financial statements. If the client refuses to make appropriate disclosure, the CPA should inform each member of the client's board of directors of such refusal and notify regulatory agencies having jurisdiction over the client, and if practicable, each person known to be relying upon the audited financial statements, that the report can no longer be relied upon. The omission of appropriate audit procedures in a particular engagement might be discovered during a peer review or other subsequent review of the auditor's working papers. AICPA AUC 585 and PCAOB 390 states that the auditors should assess the importance of the omitted procedures to their previously issued opinion. If they believe that the omitted procedures impair their ability to support their previously issued opinion and their report is still being relied upon by third parties, they should attempt to perform the omitted procedures or appropriate alternative procedures. Because of the legal implications of these situations, the auditor should consider consulting their legal counsel. And this is the end of the presentation for Chapter 16.